Alejandro Ventura here with again my new friend, my good friend, all new and old friend, Greg. So today we're going to talk about the recent changes with mortgage fees. There's a lot of controversy and misinformation about what is going on and how this affects you as a buyer with good credit and as a buyer with compromised credit.
Mhm.
So, as you may or may not know, there has been a push for housing affordability by the U.S. Federal Housing Finance Agency that essentially calls for changes on mortgage fees originated by private banks nationwide. These fees in question are known as LLPA, which stands for Loan Level Price Adjustments. And Greg is about to unpack exactly what that means here in just a moment. Now, the reason why this move by the government has been met with some level of controversy is because these changes are perceived to help buyers with risky credit by offering them a lower rate and penalizes buyers with good credit by having them charge or pay a higher mortgage rate. And again, this is at face value. Greg is going to clarify whether or not this is the case. So under these new rules, for example, buyers with credits between 680 and 780 are going to see an increase in mortgage cost, uh, especially if they're putting down 15 to 20% as a down payment. Whereas buyers with a credit score of 679 or lower will see lesser fees, which will result in lower interest rates. So again, a lot of this is what's being advertised. Whether or not this is the case, we're about to find out. So, Greg, take it away and tell us what the situation is.
Yeah, yeah. Thanks for that. It's a heck of an intro. Love that.
Hmm.
So yeah, loan level pricing adjustments (LLPAs). These are basically price tags on your interest rate. So when you think of like a price tag on a car or multiple cars, the price tags are going to look different depending on what the car is, right? And if you're financing that car, the price tag changes based on your credit worthiness, so to speak. So LLPAs, you can think of those as price tags on your interest rate when you buy a home. And those have existed since mortgages have existed. The people who decide and the people who are instituting these changes, the FHFA, the FHFA is in charge of Fannie Mae and Freddie Mac. And these are the two groups that buy up all of the mortgages after you get your mortgage. So if you get a mortgage at STCU or at Chase or at CMG, ultimately, most of the time, those banks sell your mortgage to Fannie Mae and Freddie Mac. And so basically, what that means is because Fannie Mae and Freddie Mac buy the mortgages, they get to set the rules, right? They're the ones with the cash, they set the rules. If you don't like their rules, go get a loan from somebody else, is basically the way they kind of go about it. So there's recent changes effective May 1st on these LLPAs. And the changes that were made across the entire board in terms of down payment and credit score. LLPAs existed before this, but Fannie Mae and Freddie Mac have adjusted the numbers. The controversy or the perceived controversy is because lower credit scores got adjustments that made their interest rates more affordable. Higher credit scores, some of them, not all of them, and I'll show you in a second, got adjustments that made their interest rates less affordable. So what people are saying is that, well, I'm being punished because I have a higher credit score. If I have a 740 credit score, why should I pay more than somebody with a 660 credit score? The answer is you won't. You won't. But the adjustments at this time were more beneficial for the person with the 660 than the person with the 740. So let me show you what I mean. I'm going to share my screen. Okay. So this is a heat map. It's a chart that basically shows, based on your credit score and your down payment, how your price tag for your interest rate, your LLPA, changed. So there's a lot of numbers on a page, but let me just break this down. On the left side, this column right here, this is your credit score. Lowest credit score is down here, 639 and below. Highest credit score at the top, 780 and above. On the top, you've got your loan to value, which represents your down payment. So all the way on the right, 95% loan to value, meaning you're putting 5% or in some cases 3% down. 90 to 95 means you're putting 5 to 10% down, 10 to 15% down, 15 to 20% down, and so on and so forth. So when we look at this chart, we say, okay, for someone who's putting 10% down and has a credit score of 639 or below, so you go 639, you go to 90%. And so what this chart is showing is that there was a decrease in the cost of their interest rate as of May 1st by 0.625%. You contrast that with, say, somebody who's got a 740 credit score and is putting down the same amount, 10%. Well, the cost of their interest rate went up by 0.5%. This is of the total loan amount. Okay. So people are immediately assuming that effectively what this means is that the person with the 639 credit score gets a better interest rate than the person with the 740 credit score, because the changes look like this person is paying 0.5, this person is paying negative 0.625. But this is merely the change from what the prices previously were. Let me show you what the actual prices are. So this is what the cost associated with each category is outright as a result of these changes. So let's go back to our example. We said less than 640, 10% down. It costs an additional 2.625% of your loan amount for the cost of your interest rate if you're in that category, as opposed to a score of 740 in that same category. It costs 0.75. So what does that mean in terms of real dollars? It means a person in this bracket right here, if you borrowed $100,000, you'd have a fee of $2,600. This person up here, if you borrowed $100,000, you'd have a fee of $750. So was the change more beneficial for folks down in this category? Yes. But does that mean that you should not work hard on your credit and that you should be concerned that people with worse credit are getting better interest rates than you? No. What it means is that the pendulum has swung to make housing more affordable for folks who maybe have had challenging credit moments in their history, and that Fannie Mae and Freddie Mac are doing their best to make housing and make credit more accessible for people who have had a history of maybe some blemishes on their credit, working hard to get their credit back up. It's still really expensive to get a house with a 639 credit score. 2.625 on top of whatever your other fees are is expensive, but it's less expensive than it was previously.
One of the arguments that I came across, if you go back to the previous slide that reflects the changes, the increases,
Mm-hmm.
At the bottom of the, let's start with the bracket with the risky buyer, credit
Yep.
score less than 639.
Yep.
down payment 5%, between 5 and 10%.
Yep.
Now their fee went down, according to the chart, by 6.25, right?
Mm-hmm. Mm-hmm.
Whereas the buyer with good credit, it's between 740 and 759, down payment 10% or so, their fee went up 0.5.
Mm-hmm.
So the argument that I came across is that increase, although even though marginal, is actually funding or footing the bill to subsidize the
Mm-hmm.
decrease for the buyer with poor credit. What is
Mm-hmm.
your take on that?
So the FHFA has come out in a statement and said, we're not orchestrating cross subsidies. I don't run their books. And so, we're not privy to how they negotiate that. So you can choose to either take them at their word and say, oh, well, they're not. Great. Or you can say, no, I don't trust that. I think they are. Regardless, if you want to get a conventional loan, then this is currently how the pricing structure is set up. I do know that there are folks that are lobbying for the increases to be shifted, not the decreases, right? Um, the union associated with home builders across the country is lobbying for the increases to be dropped, but to leave the decreases in place. Again, whether or not the FHFA will incorporate those changes based on the lobbying, stuff to know. Stuff to know. I do know there's a lot of noise being made. I do know that there have been some congressional bills proposed to impact these changes. But other than what the FHFA has made in terms of statements, I can't comment because I don't have any information other than that. So whether or not they are subsidizing or providing a cross subsidy, they say they're not. On the back end, if they are, then I don't know.
Okay. So to avoid then any speculation, let's just stick to what we know that is black and white, and that is that buyers with poor credit are getting a larger break on
Mhm.
fees. The buyers with good credit are getting a slightly increase on their mortgage fees. Overall, someone with a 730, I mean 630 or lower credit score is still significantly paying more than
Correct.
someone with 680 or above credit score. So the
Correct.
notion that these changes are making it for buyers with good credit to actually pay a higher cost for the loan overall than someone with more risky credit is just unfounded.
Correct. It's untrue.
That's what we can tell based on the information that we have on hand as to whether or not these increases on slight increases for borrowers with good credit is in an effort to subsidize the changes or the break given to the other buyers. Your guess is as good as mine.
Yeah, that's a larger question for do you trust what your government says? And that's not something that I'm going to wade into.
Yeah, we don't want to get into that right now. Maybe next week.
Yeah, right.
Yeah, yeah. Alrighty. Anything else that we need to know about these recent changes? So they became effective then May 1st, because I saw the pushback, like you said, by lawmakers or lobbyists to uh, put that on hold. But it looks like they became effective this week.
Yeah, many lenders actually started to build in incrementally, started to build in this pricing ahead of time. And most lenders do that when they know that there's going to be a change coming down the pike. They start to build it in incrementally. So it's not just this like big, kind of snap where your pricing gets dramatically worse. So I would imagine that if you're shopping right now, your lender has integrated this already and probably integrated it in March, maybe April. So, for most folks who are shopping right now, this is already built into your
That was already accounted for a while ago.
Yeah.
Cool.
Yep.
Right, my friend. Thank you so much for the clarification, and I hope you guys now have a better understanding of what these changes on mortgage fees entail and how it potentially affects you as a buyer. And for further questions, you can reach out to Greg directly. How can they get in touch with you?
Yeah, give me a call. Greg Conley, CMG Home Loans. Quick Google, bring my information up. And then, in the comment of this video, I can pop in my phone number in there as well. So Greg Conley, CMG Home Loans.
Perfect. Right. Well, thanks, Greg, for taking the time to help us out to better understand these changes. For those of you watching, thank you for watching. Have a great weekend.
See ya.